You've done the research, you found a cause you care about, but right before your finger taps confirm donation, a familiar question creeps in. Where exactly is this money going? We've all heard the stories. Well-intentioned donations swallowed by bloated executive salaries, luxury office spaces, or founders treating a nonprofit like their personal bank account. Let's look at how this is supposed to work, using a South African addiction recovery charity, such as UACT, as our test case. When you donate to an organization like this, you will notice they carry a Section 18A designation. This functions as a legal contract with the South African Revenue Service, carrying obligations that extend far beyond a simple tax deduction. By accepting that status, the organization is legally bound to generate approved public benefit, which means there are rigid rules governing exactly what they are allowed to buy with your money. This legal framework subjects the donation to specific spending requirements, moving the gift out of the realm of personal discretion and into a space governed by tax law. When you give to an addiction recovery charity, the impact you picture is direct. You want to fund counseling sessions, community support groups, and prevention education, and the law easily allows for those tangible expenses. Your donation can buy educational materials, secure community venues, cover transport to reach vulnerable communities, and provide practical food support. But this is where public expectation clashes with reality. There is a pervasive assumption that a legitimate charity should have zero overhead, run entirely by unpaid volunteers working out of a church basement. Delivering a professional-grade service actually requires an operational machine. This diagram shows how a single donated rand must split to be effective. One part directly funds the public benefit, but the other part has to fund the operational infrastructure. A legitimate charity has to keep the lights on. That operational side includes necessary costs like rent, utilities, insurance, required accounting and auditing, and strict data protection to safeguard patient records. Then there is the issue of salaries. Paying professional facilitators and administrative staff fairly for genuine work is entirely legal. Notice how this node connects right back to the public benefit loop. It's the paid staff who actually drive the mission forward. You cannot solve a community crisis without a sustained professional effort. Bridging the gap between the problem and the solution legally requires funding the machine that does the work safely and properly. There are, however, absolute boundaries. We can visualize the legal limits of Section 18A as a strict firewall, separating legitimate operating costs from prohibited activities. The law strictly forbids using these funds for personal spending by the founder. There can be no dividends, no profit distributions, and no luxury expenses designed for private enrichment. The organization cannot act as a personal piggy bank. It is also prohibited from using charitable funds for political campaigns, offering private benefits back to the donor, or running unrelated commercial activities. To maintain the separation, a compliant charity has to track exactly where every rand comes from. Not every payment they receive falls under the Section 18A umbrella. This table breaks down a typical income ecosystem. At the top, Section 18A donations are strictly reserved for approved public benefit programs, while grants are tied directly to specific grant agreements. But a charity might also earn external income. As you see on the bottom rows, they might charge commercial fees for training courses or accept corporate sponsorships. The law demands a clear, distinct line separating those commercial activities from genuine public donations. A legitimate charity does not operate out of a single murky pool of cash. It manages a highly regulated ecosystem of distinct income streams, with each one bound by its own rules of engagement. So, how do you, the ordinary taxpayer, know the charity is actually playing by these rules? It comes down to a mandatory paper trail. A Section 18A organization is required to keep proper accounting records, meticulously track where every donation goes, and retain the receipts to prove it. Accountability is enforced through regular reporting to SARS and other regulators, where the organization must prove that every rand supported an approved public benefit activity. Tapping Confirm Donation for a compliant organization like UACT fuels a regulated, transparent system designed to turn a gift into a measurable public benefit. Ultimately, the law exists to guarantee one simple standard: charitable money should create public benefit, not private profit. This video is for general educational purposes only and is not legal or tax advice. Consult SARS or a registered tax practitioner regarding specific circumstances.